Hey, good afternoon once again, Market Rebels. It's great being back here on Monday after missing last Thursday and Friday for RebelCon. So for all of you who are at RebelCon, it was great meeting. I think I met most of you, or certainly a good part of the group, but it was so wonderful to see all the people that I normally see only in Q&A by text. But if you didn't join us, you really should come to future events. They are so much fun, learn a lot, and the networking is just off the charts. We had a fabulous time. But we will be back on schedule for this week, Monday, Thursday, Friday, 4 p.m. Eastern Time for Trading Tune-Up. So for today, I thought what might be a helpful topic for our traders is something that's a little bit obscure to most traders, unless you learn it the hard way, and that is free rides and liquidations. So these are what fall under Reg T violations or Regulation T. I'll talk more about that in a moment. But a lot of times I've heard traders that'll say, maybe for these volatile markets, I don't want to open a margin account. I want to do what's called a cash account. And sometimes it sounds like it's being more diligent and being safer because you're not going to go on margin. But remember, you're not required to go on margin, but there are a lot of traps you can end up with in a cash account. And that's something that most traders don't understand. And two of the ones we're going to talk about here again are free rides and liquidations. So let's get started with that and find out what the traps are and how they can be prevented. So the first one, there's several different types of stock accounts, but we have one that's actually called a cash account, and then we have a margin account. Now, if you have options, the ability to trade options, that must be done in a margin account. Unless you're in an IRA, it's called IRA margining. But if you're in a regular brokerage account, you do have to have a margin account. However, there's a lot of people who may not be trading options yet and just have a cash account. And this is where you can get into some sticky trouble. And to understand, we have to back up a little bit and understand what's called Regulation T, sometimes called Reg T for short. So if you have a cash account, what it means is that you must pay for all transactions in full. So if you buy $10,000 worth of stock, you have to have $10,000 worth of funds in the account before you place the trade. But they've got to be fully paid for. If you have a margin account, on the other hand, you have the ability to, remember you're not required to, but you could pay 50% down and borrow the remainder. So if you buy $10,000 worth of stock, you could deposit $5,000 and actually control $10,000 worth of stock. And of course, that's going to give you 2-to-1 leverage. So if the stock goes up 5% after a certain time, you're going to be up 10%. And if it goes down 5%, you will also be down 10%. So remember that the leverage cuts both ways. For these margin accounts, it is subject to a $2,000 minimum. So you can't buy $1,000 worth of stock and be on margin. It's got to be at least a $2,000 minimum. But within a margin account, you can end up with what are called free rides and liquidations, which are Reg T violations. I'm sorry, within a cash account as well. Free rides and liquidations. So these are two of the ones that we're going to cover. They are the most common. And they're really what are called the T+2 settlement violations. So T+2 is shorthand for trade date +2. Now, way back, it used to be trade date +5, then it was trade date +3. Now we're at T1. Some people have said we're at T2. People have been speculating it's going to go to T+1, and it really never has. So T+2, what that means is that you have to settle the trade 2 business days after the trade date. So let's say that you buy stock on a Monday, and we don't have any holidays in between here. We don't count the trade date. So if you buy on Monday, we just go 1, 2, it would settle on Wednesday. If you bought them on Thursday, you go 1, Saturday's a non-business day, Sunday's not a business day, it would settle on Monday. Now, of course, if there's any holidays in there, we wouldn't count those as well. But it's going to settle. So what does it mean to settle? Well, that's really when all of the cash and securities changes hands kind of behind the scenes at a brokerage firm. So as an analogy, imagine that if I write you a $100 check and you deposit it in your account, you might look in the account and it says, yeah, you've got a $100 deposit. My account won't even show up because it hasn't cleared yet. The bank has no idea that it's been written. But in some time, might be 2 or 3 days, suddenly the cash shows in your account that it's cleared, and that's because it has settled. So see, there's a difference between depositing that check versus to where you could go use the cash, which is what's called settled cash. So that's really the key. We have to be dealing with settled transactions, and they occur in trade date plus 2. And this is where the problems occur. So let's start with one that's called a free ride. And this is in a cash account. Remember that you must pay for the purchase of a security before selling it. This is the key phrase, before you sell it. So it's not saying that you're not allowed to buy it, but you just cannot buy it and sell it. So if you sell before fully paying, they call that a free ride. And in this case, the broker at least will ultimately put a 90-day cash up front, or in the business, we call it a cuff. Different brokers have different rules. They can make them stricter, but they can't relax them. But there are usually FINRA rules that will allow them to maybe give a notification on the first as kind of a warning. But there's a series of progressions, and ultimately you could end up with a 90-day cash up front restriction. And that means you're going to be restricted from just sales. I'll talk more about that in a moment, but this is where it can really lock you up, especially in volatile markets. So free rides can be a little tricky to understand, so they're best shown by example. I'm just going to run through some examples and show you why some pass and some don't. Let's look at example number 1. You buy $5,000 worth of ABC stock and you sell it today. Now remember, you're in a cash account. So because the stock was fully paid for on the trade date, you can sell it at any time. You own it, it's yours. So that's a real easy one. You had cleared cash, or actually a lot of times it doesn't even have to be cleared, but the check has to be deposited. So you had cash in the account, you paid for it, it's yours, you can sell it at any time. You could sell it 10 seconds later, days, weeks, years, whatever. You're absolutely fine. Example number 2, we're going to get a little trickier. Let's say that you sell $5,000 worth of ABC stock today. We'll make today a Monday. So in your mind, you're going, oh, I've got $5,000 cash. Well, not really. It's not settled cash. And so you buy $5,000 worth of XYZ stock on the same day. Now notice these are 2 different tickers. So you're selling ABC, you're buying XYZ. What's going to happen here? Well, notice that the sale of ABC on Monday occurs on the same date as the buy on Monday. When do the trades settle? T plus 2. Don't count the trade date, count 1, 2 business days later, they both settle. So imagine this, your broker's going, okay, you just bought $5,000 worth of securities. Where's the cash? Well, guess what? It's going to be in the account because it settles on the same day. Just think about it like that check example. The broker's going to look and say, yes, there is cleared cash in here. It is settled cash. That's the difference. So that would be absolutely fine because notice you did it on the same day. In the business, we call this meeting settlement or matching settlement. The trades will match or meet settlement. So that one's okay. There's an example of a buy and sell of different securities. Let's step it up a bit. You sell $5,000 worth of ABC stock on Monday, and you buy $5,000 worth of XYZ on Wednesday. Hopefully you're starting to see what's happening. This should be okay because, again, you would have settled funds on Wednesday, right? You're doing the sale on Monday. Ask yourself, when do they settle? Count 2 business days later on Wednesday. Boom, you've got cleared cash, and that just so happens to be the date that you're buying. That's fine as well because you're meeting settlement. Now let's get into some examples where it's not okay. Example number 4, you sell $5,000 worth of ABC stock on Monday, and you buy $5,000 of XYZ on Tuesday. See, I've just delayed it by a date. So you can see where a lot of new traders will say, hey, look, I just sold $5,000. I have $5,000 cash. I'm going to go out and buy $5,000 worth of stock or a mutual fund or whatever on Tuesday. It's not okay. I'm sorry, the buy would actually be okay. I think I got a bullet here. Yeah, the purchase is actually okay, but you can't sell it without fully paying. Because remember what the rule is. You can't sell it before fully paying. It's okay to buy it, but you cannot buy it and sell it before it's fully paid. So if you sell $5,000 worth of XYZ stock on Tuesday, this is the same stock that you bought. It's not okay. It hasn't been paid for yet. Why? When does it settle? It's going to settle on Wednesday. See what happened here? You sold it on Monday, ABC. You bought XYZ, but then you sold XYZ on the same day. The buy was okay, but not the sale because it hasn't been fully paid for. And this is what's called a free ride. And the reason the brokers and FINRA does this is that they're, if you had any kind of relationship with a brokerage firm, you could say, buy me 10,000 shares of Tesla, and I'm good for it. I'll bring it in 2 business days. The stock goes up 10 points. You sell it, and you go, you know what? I don't have to bring in a check. I'll just speculate with the market's money. That's where it gets the term. And what would happen? Well, if it goes up, great, you're making money. And if it doesn't, you can walk away from the account and leave the brokerage firm hanging. And it becomes a big risk to the industry. That's why they call it a free ride. You're just speculating with the market's money. So that's going to ultimately result in a 90-day cash upfront restriction on your account. All right, so let's take a look at that graphically. You do the sale, and when are they going to settle? They're going to settle on Wednesday, but notice you did a buy and a sell on Tuesday. But this buy has not been fully paid for until Wednesday, but you've already bought it and sold it long before the settlement. See, it starts to get a little tricky. It's not real easy to try to figure out when these settlement dates match, and that's why it can be so tricky in a cash account. So that will result in a free ride. Again, that's a 90-day cash upfront restriction. Sales are permitted, but you may still make purchases, but you must fully pay with cash on the trade date, not from the sales of other securities, even if they meet settlement. It's got to be new cash. So it can be a very harsh penalty. So the ultimate thing, if you are in a cash account, you can always avoid cuffs by paying for each trade on the settlement date. But again, that can be kind of a pain, especially if you want to place a trade and say, I can't get the cash for another day or two. That's fine if you've got a margin account. This is where margin accounts can really help you. So now let's take a look at a liquidation. A liquidation is another type of a Reg T violation. Very similar, but what we're going to do is to do different securities. So let's say that you buy $5,000 worth of ABC stock on Monday, but you sell $5,000 worth of XYZ on Tuesday. So again, in your mind, you're thinking, hey, I'm fine for this buy because I just sold $5,000 worth. No, you're not. You did it on a different date. That is a liquidation. And again, that's going to land you a 90-day cuff restriction. So here's what happened. You did your buy, and now, if you had sold on the same date, you would meet settlement. That would have been fine. But you waited a day to do the sale. And what happened then, the broker's going to say, well, the settlement wasn't here until Wednesday. Okay, so your buy, think about this. The funds are showing up on Wednesday. I'm sorry, the transaction that you have to buy, and the broker's going, where's the funds? They're not there until Thursday because you sold on Tuesday. The broker's look and go, the cash isn't here. And we can see it's coming in, but it's not settled funds. They're not going to be here until Thursday. And so that's going to be a free ride. A liquidation. So the point is that they get very technical. I think the big point that I want to make is if you have a cash account, and especially in markets like this, where you might be seeing some good opportunities to buy or sell, you can get caught. If you are day trading in a cash account, you are definitely going to get free rides or liquidations. So a margin account is a real benefit, even if you're trading shares of stock and even if you never plan to trade on margin. And this is why. So again, it's one of these little subtleties that a lot of people don't understand. Again, kind of behind the scenes operations with the brokerage firms. There are other ones. There's what's called a good faith violation that are very similar. These are the two most common. But once again, I think my big point is if you are unsure, if you're in a cash account and you're unsure about whether it's okay to buy or sell, pick up the phone and call the broker. Better than learning this stuff the hard way. So as always, remember, it's not just about memorizing formulas or strategies. It's about understanding why these violations occur and how they occur. Because sometimes if you're faced with a really fabulous opportunity and you can't participate, just because you didn't understand, that's not a good place to be. And these are among the many things that we always cover in our Q&As and webinars to help traders keep from making these types of mistakes. So for anybody who would like to learn more, absolutely free 30-minute one-on-one assessment with one of our world-class coaches. Phone number is 888-809-8058. Pick up the phone, give them a call, and you can't even imagine how much information they can fill your head with in 30 minutes. It's worth its weight in gold, even for the paid classes, but when it's free, you simply can't beat it. So give them a call, 888-809-8058, and I hope that helped, and I look forward to seeing you on Thursday.